The Housing Assistance Tax Act of 2008 was a cornerstone response to the tumultuous housing crisis that gripped the nation, ushering in an era of reform and support for a sector in dire need of stabilization. This landmark legislation provided many benefits and opportunities for homeowners, buyers, and investors as it sought to revitalize a flagging housing market and mitigate the broader economic fallout. Key highlights of the act include tax credit for first-time homebuyers. One of the act's most appealing features was the introduction of a substantial tax credit for first-time homebuyers. This credit aimed to invigorate the housing market by encouraging potential buyers to take the homeownership plunge. This provision supported individual buyers and contributed to the overall recovery of home sales. Deduction for property taxes. Recognizing the burden of property taxes on homeowners who didn't itemize their deductions, the Act allowed for an additional standard deduction for real estate taxes paid, providing much-needed tax relief and lowering the overall cost of homeownership. And 3, homeowners who held real property as an investment property and now move into the property as their primary residence are only allowed a prorated capital gains exclusion for real estate during the year of non-primary use. Previously, and as still thought by many, it is that when you move into an investment property as your new primary residence, if you live there for 2 out of the most recent 5 years, you can then use your capital gains exclusion for the entire gain upon sale. That is not the case after the Act went into effect. Think about how this affects older homeowners who wish to downsize and move into a smaller investment property they have owned. What is very common in divorce is that one spouse retains the marital home and the other moves into an investment property as their new primary residence. It may be easier to understand this tax rule with a visual example. Any property purchased prior to January 1, 2009 is grandfathered in to previous tax rule. An owner could move in and out of this property going from primary to investment with no tax consequences. Property purchase after January 2009 will fall into the new rules of the Housing Assistance Tax Act. Let's say that John purchased an investment property January 1, 2018 and rented the property out until December 31, 2019. On January 1, 2020, John moves into the property as his primary residence after divorce and sells the property on December 31, 2022. Just to clarify the dates, the non-qualified use period was for 2 years, 2018 through 2019, as an investment property. It was used as a primary residence for 3 years, 2020, 2021, and 2022, all totally the 5 years of ownership. The property was purchased for $400,000, and during the 2 years of non-qualified use, $20,000 was deducted as depreciation for income reporting purposes. John sells the home in 2022 for $700,000, realizing a gain on the property of $300,000. Under the Housing Assistance Tax Act, John can only apply his capital gain exclusion to the total gain on the property during the qualified use period, in this case 3 years. The 2 years of non-qualified use are now subject to capital gains tax. In this example, 2 out of the 5 years, or 40% of $300,000, is $120,000. John would have to pay capital gains tax on the $120,000. Additionally, the $20,000 of previous depreciation claimed during the period of non-qualified use is recaptured as ordinary income for the tax year. The home was sold under the unrecaptured tax code 1250 gain. How many of your past clients, divorcing or not, moved into an existing investment property as their new primary residence? This is a common situation in divorce. One spouse retains the marital home, and the other spouse moves into an existing investment property as their new primary residence. Given the potential capital gains tax and recapture, is this fair and equitable? Don't assume family law attorneys are aware of this tax code, because they aren't. In fact, many financial advisors aren't either. Make sure you recognize this potential tax event, and don't be afraid. Do speak up. I taught this subject in a continuing legal education class once, and later received an email from an attorney that said because of the information I provided, she was able to win a litigated settlement in favor of her client who was being awarded and moving into an investment property.